Hello everyone. Welcome to today's webinar on market insights for fixed income, where we will explore key trends and opportunities shaping the fixed income landscape. I'm Sandeep Solanki, product specialist, and I'm joined by Mr. Anurag Mittal, our head of fixed income, to provide you with a deeper understanding of current market dynamics and share his insights of fixed income markets. After Anurag's presentation, we will open the floor for Q&A. Please feel free to submit your questions in the link provided throughout the webinar. Without further ado, let's dive right in. Over to Anurag.
Thank you, Sandeep. Hi, good day, everyone. I am pleased to welcome all of you in our fixed income webinar for the month of July 2025 as we complete the first 6 months of this calendar year, and we are exactly reaching the midpoint. And it's been a very tumultuous year in the sense we've had too many geopolitical escalations. We have had the tariff announcements in the month of April, and at that point of time, there was an increasing school of thought that tariffs overall will be highly disruptive and inflationary, and it may lead some emerging market central banks to kind of back off from their rate cutting cycles, and it will lead to a lot of volatility in currency. So as we stand, in the month of July, we also try to see what really has happened post the application of tariffs and all the geopolitical escalations, and what it really means to navigate in this complex fixed income environment. So we'll start up with the global trends, and we'll see how what they mean for fixed income markets and even for India, and then we'll come to the domestic policies which are really important for us and the right product suitable for us. So if you look at the slide, so like I said in the beginning, there was a widespread belief that once tariffs would start from the US, probably it will lead to slowdown in the rest of the world due to the business uncertainty and as supply chains get realigned. But if you look at the right-hand side of slide, which shows the global trade index rebased to 100 from the year 2021, we can see that in fact post the tariffs, the global trade has not really changed materially. In fact, global trade has been rebounding. And if you look at the left hand of the part of the slide, and if you look at the blue line, which is the manufacturing PMI, so for quite some time, manufacturing PMI was less than 50, which kind of signifies a slowdown in the particular sector. But if you look at from June, in fact, manufacturing PMI picked up. And the reason was that what we saw similar pattern emerge in Trump 1.2 as well. When tariffs were applied on China exports to the US declined, but China exports to the rest of the world, and their consequent exports to the US picked up. A similar trend is being seen even in current times, where although China exports to the US are largely stable, China shipments to rest of the Asian regions, such as Indonesia, Thailand, Malaysia, Vietnam, etc., have picked up, and their exports to the US, have gone up in the month of May and June. And if you look at the current trade deal also, which the US has done with the Vietnam, the US has levied a 20% tariff on Vietnam for its direct exports to the US, but there is a 40% tariff on transshipments from Vietnam, which broadly means, although the official notification is still yet to come, but transshipment in its general terms means that goods which are not originating from that particular country, but they have been exported from some other country and they have been re-exported to the US. And that tariff has been levied at 40%. So that is something which the US is now trying to correct. But in the meantime, overall manufacturing remains quite stable. Global trade remains quite stable. Shipping rates are going up. And overall global manufacturing momentum is quite I would say strong right now. If you look at the main reasons for this pickup in global manufacturing momentum, it was driven by robust, transportation demand. So basically, it's just the shipping lines which were not being used, which the producers were waiting to see the impact of tariffs. They have started to normalize. If you look at the service PMI, which is the orange line, uh, that continues to see sustained, expansion. So it's been above 50 for a while now. So broadly, manufacturing for which was lagging services for a large part of 2024-25 is now again picking up, while services continue to be strong. So broadly, from a global growth perspective, we do continue to see stability going ahead as well. Coming on to the other major event which happened in June, which was the FOMC meeting, and largely the FOMC left federal fund rates unchanged in a range of 4 quarters, 4 half, which was largely expected by the market. The dot plot, which reflects the median participants' expectation of rates during a particular period, that continued to see two rate cuts in 2025. That was also largely in line with market expectation. But if you look carefully, the 2026 and 2027 terminal rates have been revised upwards. So broadly, the committee sees only 25 basis cut in 2026 and 25 basis cut in 2027. And the reason for this upward revision in terminal rates, as we can see on the right hand side of the table, uh, while growth expectations are not materially changed, if you look at, for example, 2026 real GDP growth, committee is only expecting now 1.6% growth compared to 1.8% growth, which they were expecting in March 2025. But if you look at inflation, they are now expecting a 3% inflation in 2025 and a 2.4% inflation in 2026 compared to 2.2. So broadly, the Federal Reserve sees more of a stagflationary environment in the US where growth is slowing down, but inflation is picking up. In that kind of a economy where inflation is well above the trend line above the target, probably the Federal Committee wants to remain data dependent. They want to wait for actual data to see whether inflation is getting affected by tariffs or not. And then probably they want to make an assessment regarding future monetary easing. So we still don't think that one should, hold this as cast in stone and should only expect 100 basis rate cuts in the next 3 odd years. We think rate cuts can be much more. It's just that the Federal Reserve during the course of 2022 and 23, due to the various supply side shocks, was slightly unprepared for the kind of inflation that really took place. And probably they want to play safe. They want to see the actual data before taking any monetary action. But if we look at the current, uncertainty in businesses, probably at least in 2026 and 27, we should expect more monetary easing than what is being projected today. If you look at these are the the slide. This slide signifies two main commodity indices which drive a large part of inflation, whether in advanced economies or in emerging market economies. So if you look at the Bloomberg Commodity Index, is a broad commodity index which represents oil prices, precious metals, and industrial metals such as steel, copper, aluminium, etc. But broadly, if you look at the index did surge during the month of June on higher oil as well as higher gold prices, broadly in the middle of the June due to Iran and Israel geopolitical escalations. But as the ceasefire was announced, oil prices also came down, gold prices also saw some profit booking, and broadly we saw the commodity index coming back to 102 levels, which it has been for the whole of May and June. So broadly, we saw pullback in the commodity index. If you look at the global food prices, while they rose 5.8% YOY on higher vegetable oil prices and meat prices. But if we broadly look at the month-on-month movement, as we can see since March of 25, the food prices index has largely been quite stable. So while YOY, it may show some base effect and may show higher prices, but if you look at the majority of the food items, they are largely stable throughout the globe on favorable weather patterns. We do expect food prices to remain stable in the near term. However, one should continuously monitor the direction of food prices and the way, especially vegetable prices, oil prices are going as they impact food basket in emerging markets, including India. So this is something to watch out for. In fact, more than the commodity index, which represents the industrial metals, which is quite stable, we need to really look out for the food index as that continues to influence inflation baskets in emerging market much more significantly than industrial metals. This is the overall snapshot of 10-year benchmark sovereign yields. So, as we saw, during the month of May, yields went up for example, US 10-year moved from 416 to 440. Similar movement was seen across major economies. But what really happened in June was, most of the, yields went back to their previous levels. The reason was largely that the fears of market, especially related to tariffs, were not realized. So when the tariffs were announced by the US on most of the other nations on April 2nd, which the US called Liberation Day, there was an expectation amongst market participants that because of tariffs, inflation will go up as producers will pass on the cost to importers, and importers will have no choice but to pass on the cost to consumers. Although the tariffs were paused, but since there was a baseline tariff of 10%, what we have seen is the consumer pricing power has been quite weak. In fact, most of the increase in tariffs has been absorbed by the exporters and importers, but it has not been passed on to consumers. And that led the bond market to see that probably tariffs will not, at least at these levels, will not lead to significant inflation in the near term. And that's what really led the bond market to see some relief. The other notable aspect of the bond market rally was also the ceasefire announced between Iran and Israel, which also led cooling of oil prices, which also led bond yields even across emerging markets to come down. So this chart really signifies, the financial conditions index, and the right-hand side chart signifies how market is assessing Fed policy rates. So if you look at the left-hand side chart, which is the Bloomberg US Financial Conditions Index, they largely remained tight. So while in the previous slide we saw that US 10-year rates have come down marginally during the month of June, the conditions remain tight largely because of US fiscal concerns. So as we know, during the month of June, there was a lot of uncertainty whether the US government will be able to pass on the one big beautiful bill, which was kind of introduced by President Trump, which basically called for tax cuts to be continued, which he had introduced in his previous term, and some also spending cuts, especially on subsidies. So, but although the bill has been passed, bond market participants are concerned what it really means for US fiscal deficit in future as well, and whether that that high fiscal stimulus, which will be continued why this bill will probably not really let inflation in the US come down. The other reason, of course, like we discussed previously, that Fed continues to be cautious on the economy. They don't really see too much of an impact of the uncertainty on growth, but they do see impact of tariffs on ultimate inflation, and hence, given the US fiscal concerns and a cautious Fed, financial conditions overall continue to be tight in the US. the same is getting reflected in the market implied policy rate forecast. So as we can see, the bond market is probably forecasting only 75 basis cuts over the course of next 12 months, which is largely in line with the dot plot. So we need to see either undershooting of inflation compared to the expectations or undershooting of growth compared to the current expectations which has been built by various market participants as well as the Federal Reserve. Our guess is probably at some point of time the growth will start to undershoot market expectations, and that is when probably the bond market will start to price in more rate cuts. Probably once bond market starts to see some slowdown in the payroll data, that is when the concerns on growth will re-emerge, which will necessitate some repricing of bond yields. Now coming to India trends, we had the release of inflation for the month of May, which was at 2.8%, which was the lowest in last 6 years, as food inflation continues to fall due to favorable weather. If we look at this chart on the left-hand side, which shows CPI inflation, which is the blue line, food inflation, which is the red line, and the core inflation, which is the green line. And if you look at the last 2 years, 2 fiscal years, CPI headline inflation has averaged around 5%. But if you look at the food inflation in the last 2 years, it has averaged around 6.9%, whereas the core inflation has averaged only about 4.5%. So a large component of the high inflation in the last 2 years has been food inflation, which was driven high due to unfavorable weather in 2023-24. It was also high due to the adverse shocks after the geopolitical escalations between Russia and Ukraine, due to which we saw prices being high of certain cereals, certain dairy products, as well as edible oil. So as now production has increased after the initial shocks, as weather patterns have been favorable both for India as well as globally, food inflation continues to come down. And as we can see, it has been the lowest in YOY terms in several years. If you look at even the CPI diffusion index, which basically is an aggregate of constituents which are printing inflation of more than 5%, that diffusion index also continues to be stable. So only about 20% of items are exhibiting inflation of 5% or higher, which broadly means that overall inflation is in some extreme cases, but largely the underlying components of inflation are quite stable. Even if you look at from forward-looking perspective, the IMD has forecasted a normal monsoon this year. We will discuss on monsoon in greater detail in the next slide. But broadly, given that we are expecting a normal monsoon, we do expect vegetable prices and food prices to remain under well control, and hence we expect food inflation to be quite well behaved. The RBI has forecasted a 3.7% inflation for FY26. We do expect actual inflation to be even slightly lower than RBI's forecast if current trends continue. Coming to the monsoon trend so far, so if you look at the cumulative rainfall between 1st to 29th of June, which is on the left-hand side chart, as we can see, apart from the east and northeast regions, rainfall has been quite abundant in rest of India. So whether we look at northwest, which has experienced 37% rainfall, then the actual this year. If you look at central India, which has seen 24%, then the long period average, southern peninsula has largely seen flat rainfall compared to the long period average. Overall, India has seen 8% higher rainfall than long period average. So while it may look like because of eastern and northeastern sowing could be lower, but if you look at on the right hand side table, the sowing data is also quite encouraging. Mind you, in the month of June, only 10 to 15% of total sowing is done. The bulk of the sowing takes place in July and August. But so far, the trends are quite encouraging. If you look at overall aggregate sowing, is 10% higher than last year. And especially if you look at the key products which are very, very critical and influential for inflation, rice is 58% higher, pulses is 42% higher, and core cereals like millets, etc., are 22% higher. If you look at the food grain production in the last year, that rose about 6.2% as per third advanced estimates in GDP. It has been the highest in 8 years. So overall, historical food production has been quite high. The current monsoon trends are quite encouraging. If you look at the sowing data, it's much stronger than last year. So overall, we do expect the food inflation to remain well controlled going ahead as well. The other important announcement which led to volatility and a lot of confusion in the bond market was the announcement by RBI of variable rate reverse repo auctions, under which RBI basically absorbs liquidity from the interbank market. So RBI announced a VRRR of about 1 lakh crores, out of which about 86,000 crores was tendered in the auction, the rate and which came at 649. Why it was important for the market was because of very high liquidity in the interbank market. So right now, interbank liquidity is around 2.5 trillion rupees, due to which the actual, the tri-party rate or the call rates are even lower than the SDF rate. So since the policy rate is at 5.5, the SDF rate is at 5.25, the actual tri-party or the secured funding rate in the economy is even lower than 5.25. Now, since the market is pricing its whole money market curve, at less than 5.25, because if your overnight rate is, let's say, close to 5.15, 5.20, your T-bill rates, your CD/CP rates, and your bond market rates price accordingly. The announcement, of VRRR by some market participants was seen as probably a reaction from RBI to move the interbank rate close to the policy rate of 5.5. So in a way, an effective tightening of 30 basis points. And of course, if the overnight rate is being tightened by 30 to 35 basis points, it also leads a corresponding impact on other asset classes as well. Through this chart, what we have tried to analyze is the previous VRRR auctions and whether they have impacted overnight rate. What we have really seen previously, even during 2022 when the liquidity was abundant and RBI was absorbing liquidity through VRRR, largely the objective of VRRR was to stabilize the market. So like I said in the beginning, currently the interbank liquidity is running at about 2.5 lakh crores. If we add in the government cash balance, the total system liquidity or the core liquidity is around 5.5 lakh crores. If you look at the CRR cut, which the RBI has announced, which adds to about 2.5 lakh crores from September to December. So even if, let's say, there is a maturity in RBI FX book, which right now RBI is running short by about $65 billion. Even if RBI, provides delivery of some of its forwards, the liquidity is expected to remain ample at least for the next 12 months. If the RBI had not announced the VRRR, the overnight rates had even gone probably below 5.10. So we do not really see the announcement of VRRR as an attempt to tighten liquidity. We do not see the announcement of VRRR as an announcement or a view on or a measure by RBI to give a yield signal to the market. We largely view the announcement of VRRR as normalization of liquidity. Liquidity is quite ample. In fact, in next 2-3 months, liquidity could even increase as government spending picks up, and that is why probably RBI announced, the 1 lakh crore VRRR to ensure the rates remain stable. In fact, even after the announcement of this 1 lakh crores of VRRR, the overnight rate, especially as indicated by the tri-party or TREPS rate, they are still below the SDF rate, which is 5.25. So broadly, there is no impact on the money market rate curve because of the VRRR option. Of course, we'll have to see and watch out this space whether RBI continues to upsize the VRRR or whether they start to gradually increase the frequency of VRRRs. from 7 day to 3 day or 1 day, which could give a proper yield signal to the market that probably RBI was to hike overnight rates. But at least for now, we do not think that's the case. We just think that RBI is fine-tuning liquidity, is just ensuring that the liquidity remains close to at least the SDF rate, if not the policy rate. So broadly, this chart signifies credit and deposit growth. So as we can see, the demand for non-food credit continues to slow down. Even for the month of June, the non-food credit growth continued to be below 10%. It was 9.4 if we compare it to 9.6% YOY in May 25, while deposit growth continued to outpace credit growth. In fact, if you look at the CD issuance in the month of June, that was about 20% lower than the maturity of CDs as well. And if we look at even banking behavior, the fact that banks have been reducing saving account rates also reflect that they are quite comfortable on liquidity. They are not looking to attract deposits at this point of time. If you look at overall, what were the major drivers of the slowdown? The major drivers of the slowdown was, largely credit to NBFCs, which have seen a sharp decline. We have also seen sharp decline in credit towards unsecured personal loans and credit card, which also continues to see normalization by the banks as they focus on asset quality. While credit growth can pick up in the festive season, which is probably in the second half, we do expect credit growth to stay muted at least in the next couple of months. And hence, if you combine high liquidity, lower credit growth, and high deposit growth, we think money market at the short end of the yield curve could remain quite stable. From a trade perspective, things were quite stable for India. So again, as we can see, there was a sharp uptick in the trade deficit in the month of April due to the probably as a front loading of again ahead of Liberation Day tariffs. But if you look at May 25, trade deficit went back to the usual run rate of $21-22 billion. It printed at $21.9 billion, as largely if we can see the impact of oil imports. So oil imports from $20.7 billion in the month of April, they fell to 14.8. So largely other components of the trade were quite stable, but because of this decline of about 5 billion, we saw the decline in trade balance to a more manageable $21-22 billion number. If you look at the service surplus, although it reduced moderately to a $15.3 billion from 15.9 in April, but largely our service exports continue to be quite stable. If you look at remittances, even remittances from abroad continue to be quite healthy. So overall, we do not really expect any current account issues for FY26 as well. So despite lower portfolio flows, if you look at FPI or FDI, they continue to be low. In fact, we continue to see portfolio outflows from fixed income market as well. But we do not think that given our high service exports as well as high remittances, we should have any balance of payment issue for FY26 as well. We could expect higher capital flows, probably in a time when US Fed starts to ease, US dollar rate come down, and probably more money will start moving towards EM. And that is when probably India can see more capital flows at that point of time. If you look at the fiscal situation was quite, again, strong. If you look at the non-tax revenue for the month of May 25, the total non-tax revenue came at 2.9 trillion compared to 2.2 trillion in May 24. The main reason for this was the RBI dividend, which was declared at 2.7 trillion compared to the budgeted number of 2.1 trillion. So it was about 60,000 crores higher than the budgeted estimates, which gave this boost to the fiscal deficit number. So the fiscal deficit number for the 2 months of April 25 and May 25 is just 2% compare of the budgeted estimate for the whole of FY26. If we look at on the tax revenue side, we are seeing some bit of slowdown in corporation tax. So as you can see, for the 2 months of fiscal year, which is April to May, the corporation taxes are actually down by 0.8%. Even the income tax growth is just 6.4%. But if you look at the GST collection, the GST collection continues to be quite high at 24% growth YOY for fiscal year to date, April to May, 26 over 25. So overall, GST collections continue to be quite high. Non-tax revenue also is much better than expected, and hence we think even if tax collections would be lower than what we expected in the budget, we do expect the government to continue to meet its fiscal deficit target. The expenditure side as well, we saw some growth, about 20% in the 2 months FY26. The capital expenditure continued to be high. Even the defense spending picked up in May. So the typical run rate of defense spending is usually 5 to 6,000 crores per month. But in the month of May, it picked to 21,000 crores, probably due to some temporary requirement by Indian Defense Forces due to its geopolitical escalations in the region. And secondly, there was about a 19,000 crores short-term loan to FCI, which should be repaid within the year. So just to give a perspective, while government allots a certain amount of subsidy to the Food Corporation of India, but what really happens throughout the year is Food Corporation of India procures the wheat and rice from farmers for public distribution, in the various free ration scheme that the government has. And typically there is a mismatch between the sale proceeds from the ration scheme and the amount of procurement that they have to do. So these temporary mismatches are typically tied over by the loans from Government of India, which should be reversed during the course of this year. So just an update on the SDL and T-bill borrowing calendar. So about 2.9 trillion rupees was announced as Q2 borrowing calendar for the state governments, which compares to 2.4 trillion for FY25 and 4 trillion for FY24. Broadly, we expect, as we can see from historical trends, typically states tend to borrow, especially in the Q1, Q2, they tend to borrow lower as cash flows, they are still to spend on their capex or their other requirements. So typically in the first half, they borrow 60 to 80% of the announced calendar. And it is typically in the second half when they borrow up to almost the 100%. So we do expect, while the borrowing has been announced at 2.86 trillion, we do expect states to borrow slightly lesser in the quarter, for FY26. If you look at the T-bill borrowing, that's come at about 29,000 crores less than the maturity. So if you look at the total, T-bill borrowing for Q1 and Q2 of FY26, that's about 95,000 crores less than the maturity. This is largely a reflection of very comfortable government cash balance because, like we've discussed before, RBI dividend has been quite high. Overall GST collections have been quite high, and the government is still about to spend some of that. So overall tax, since the government cash balance has been quite high, they have rightfully, tried to cut down on T-bill borrowing, which also has provided support to money market yields. So this is largely the Indian sovereign curve, which compares Indian sovereign curve movement in June 24, June 25, and the previous month, which was the May 25. So as we can see, the curve continues to steepen. The short end continues to go down, while the long end continues. Yields continue to go up, as largely the market participants are playing for end of rate cut cycle. So as RBI changed the stance from accommodative to neutral, market participants are expecting no more rate cuts going ahead, and that is why we have seen some profit booking on the long end, while short end continues to benefit from easy liquidity. So as we can see in the various curve movement and credit spread trends, we saw some probably pullback in the month of June. If you look at the AAA yields, they went from 663 to 670. Similar movement was also seen in the 3-year and 5-year rates. Largely, it's a reflection of the geopolitical escalation, which led to some amount of profit booking, and also the announcement of VRRR, which led to confusion amongst market participants that probably RBI wants to tighten the rates. But we do not think it's a structural issue. We think liquidity continues to be quite easy, liquidity continues to be ample, and hence we think these levels should correct in the near term once market participants also get a clarity that probably RBI wants to keep liquidity easy as it wants to ensure monetary policy transmission. So broadly, just to summarize, uh, while this change in stance has happened from RBI to neutral from accommodative, yes, it does indicate that the bar for rate cuts is quite high. That is, unless and until there is a significant slowdown in growth or there is a significant undershooting of inflation expectations, RBI is probably unlikely to cut. But we do still think that in case global economy starts to slow down and even domestic economy consumption starts to slow down, probably there is still some space for policy easing as inflation continues to be quite well behaved. On the other hand, even if we are not expecting too much rate cuts, one comfortable thing from a fixed income market standpoint is very high and surplus liquidity. As RBI has committed, they do intend to keep 1% of NDTL as surplus liquidity, which equates to about 2.5 trillion rupees. Uh, in fact, if we look at RBI measures, the CRR cut that they have announced, which will be effective from September, will also continue to boost liquidity at a time when probably we'll be seeing some tightness in liquidity due to currency leakage and delivery of FX forwards from RBI. So overall, we do expect liquidity to remain quite surplus. And as liquidity remains surplus, we should see some decline in yields, especially on the short to medium end of the yield curve, which basically is up to 5-year. On the longer tenor bonds, typically they tend to participate well in slightly deeper rate cut cycles, or there is a global macro theme which is emerging towards a slowdown. So they can do well in case global rate environment becomes favorable, or in case government changes the borrowing mix in the second half calendar, which we think is a high possibility, given that those spreads have become quite high. So if you look at today, the 10-year versus 30-year, that the 10-year is trading at 630 and the 30-year GSEC is trading close to 710. So about 80 basis spread compared to its long period average of 40 basis in the last 10 years. So broadly, if the government of India were to change the calendar or a global environment were to become favorable, those spreads can come down in the near term. But if one has to look at from a more risk adjusted basis, from a long term structural fixed income allocation, from a risk reward perspective, moderate duration products, which basically run duration between 1 to 3 years, provide the best risk reward. So in case an investor has a 6 to 12 month horizon, they can consider money market or low duration funds, which typically run duration between 6 to 12 months and which are providing significant accrual over liquid funds. And if some investor has a more than 1 year investment horizon, they can consider funds like short-term corporate bond funds, which are giving decently high accrual compared to your money market funds. And also they give an opportunity to participate in mark-to-market gains in case rate cycle further extends. And of course, for investors who are looking for more than 2 years and who have the mandate to invest in arbitrage funds at an underlying level, they can also look at debt plus income arbitrage, which can give them superior tax efficiency if they hold that investment for more than 2 years. So we hope that you found the session useful. I'll stop here and we'll open the floor to questions. Thanks, everyone.
Thank you, Anurag, for your valuable insights. Let's move on to the questions we have received. So, Anurag, the first question is that given the muted credit demand so far this fiscal year and the limited traction we have seen in the call money markets, Do you expect the credit demand to pick up in the second half of the year? And how would its impact be on the call money markets?
Right. So in the second half of the year, we do expect credit growth to pick up. A couple of reasons. The first reason is that typically, once right now, as we saw in one of the previous slides, on the rural economy, the sowing season is going. So typically in the second half, as harvesting happens, income reaches the farm economy, consumption picks up, and hence demand for credit also picks up. Typically in second half, there is also a festival season, which also leads to better spending and hence better credit demand. Also, if you look at the impact of rate cuts, as rates have been just cut in the last 6 months, and typically rate cuts affect the real economy over a lag of 3 to 4 quarters. We do expect the benefit of rate cuts to really take an impact in the second half of the fiscal year, and hence we expect consumption also to probably pick up in the second half, and hence we do expect credit growth to pick up. The impact on the call money market, ceteris paribus, should be slightly, um, you know, putting some pressure on yields, but it totally depends on how RBI handles the liquidity situation and the kind of flows that we are also getting. So, if at that point of time FX flows are abundant, there is more flows towards EM, probably liquidity will be easy. Also, if RBI continues to provide more durable liquidity, probably it may not impact call money at the margin. And hence, it totally depends on how the FX flows are at that point of time, or what kind of measures are RBI taking. So that is so. So we have seen periods where credit growth has been in double digits, but it does not have too much of impact on call rates.
Got it. Thank you, Anurag. While you already alluded about the VRRs, there is one question here. Interesting. Following the liquidity infusion through OMOs and FX, RBI's withdrawal of short-term liquidity via VRRs has led to broad-based rise in the yield, with sharper impact on the shorter end of the yield curve. How do you view the trajectory of short-term rates going forward?
Right. I will not call it withdrawal of liquidity. It's just fine-tuning operations. So because if it's a 7-day operation which is just being rolled over, it's not withdrawing any liquidity from the system. Mm-hmm. It's just that rather than being deployed in interbank, it is being lent to RBI, which is leading to some money market rates and call rates remaining stable. So like we alluded earlier, the objective probably by RBI was to stabilize call money rates rather than to withdraw liquidity. So it's the same RBI which has announced a CRR cut effective September in the June policy. They could have announced that in the August policy as well. But the fact that they wanted to, announce the CRR cut in June itself shows that their intent is to provide liquidity. Their intent is to ensure monetary transmission of their 100 basis rate cuts. So we don't really see it as a withdrawal of liquidity. We see it more of a fine-tuning operation to ensure that the call rates remain aligned to the policy rate.
Perfect. Thank you, Anurag. Now, here is an interesting question. In the recent past, the spreads, particularly between 30 years and 10-year segments of the yield curve, have widened beyond their historical averages. How should this development be interpreted? And could it present a technical investment opportunity? If yes, which category of funds would be most suitable to consider?
So if you see, we in the last 6 months, we have been talking about steepening in the yield curve. So as typically rate cut cycles mature, they come to their end. Typically, the curve tends to steepen as market participants at the fag end of the rate cut cycle prefer to hold short-term security. So this steepening was anticipated largely by us, and that is why we were recommending shorter duration products. If you look at the current shape of the yield curve, you are absolutely right that the current spread of 80 basis is much higher than the long period average. And probably we think that it's not just a function of market position at the end of rate cut cycle. It's also about some seasonality. Typically, first half of the year, we do see lower inflows from long-term investors, but probably that investment comes back in the second half of the year. We also saw a very duration-heavy borrowing calendar in the first half, probably extrapolating the high demand that we have seen in the last 2 3 years. We also have to be mindful that during the last year there was a very strong demand because of JP Morgan bond index inclusion, which was not there this year. So probably because of that, we do expect borrowing calendar to be slightly modified in the second half of the calendar year. Secondly, once global macro environment becomes more favorable for fixed income, we do expect some more, positions to be considered in the long duration assets from market participants as well. So from a tactical perspective, so while from a structural perspective, we still think that the risk reward justifies investment in moderate duration. But if an investor has appetite for high mark to market volatility, and they want to trade these tactical opportunities in a range bound market, we think that they can consider investment in gilt fund or long duration funds, which give them exposure to these long duration securities, and they can play for some amount of spread compression in the next 3 to 6 months.
Got it. Thank you, Anurag. In the interest of time, I will take one last question. It's regarding the income plus arbitrage, which you discussed about. So how is the portfolio allocation of income plus arbitrage? And would you continue with the current allocation, or are we planning to make adjustments given the market offers that any technical opportunities?
So the current allocation is largely concentrated in the UTI corporate bond fund and UTI arbitrage fund. So more than 60% is allocated towards UTI corporate bond fund, and the balance is in UTI arbitrage fund. The fund is positioned to take a moderate amount of credit risk, so we do not foresee any allocation in credit-oriented strategies in the near to medium term. As far as the how the allocation is likely to be there for the foreseeable future, see for right now, like I said, the view that we are holding is that probably we are in a lower for longer regime. That why we may not see significant rate cuts, we also may not see any rate hikes at least for the next 12 months. In that kind of regime, we do expect short to moderate duration to do well, and we do continue to provide best ideas to the FOF, and hence we are looking at corporate bond fund. But if there are opportunities which are there tactically, we may rebalance the fund either in higher duration or lower duration. So if spreads further kind of widen for longer end securities, we may allocate some portion of the fund towards gilt fund as well. So we do have the flexibility to do that.
Thank you. Thank you so much, Anurag, for answering all the questions. And thank you, participants, for joining us today. We trust that the insights shared by our expert have helped provide a clearer understanding of current fixed income landscape and the opportunities ahead. We truly appreciate your time and participation today. We look forward to welcoming you to our next session. Thank you.
Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.